Hello everybody, Stephen Thomas, live from Ladera Ranch, deep in the heartland of South Orange County. This is the final episode of the housing debrief for 2020 before we go dark for all of the wonderful holidays. I will be doing some brief little tiny 1 to 2 minute updates throughout the rest of the year, but I'm going to keep those extremely brief and so this will be the last housing debrief for the year. We will probably be doing our forecast for 2021 in the month of December, so look for the announcement there. So yes, we're going dark. But first, hey, I would like to introduce some amazing people that have been extreme, and everybody might wonder what this is. This is what happens when you're clumsy like me, and I was cleaning up after Zeke, after he went to bed, and I hit my head against something sharp. So there, now that that's out of the way. Yes.
On?
What's
I
on?
turned it on.
I got it on.
Oh.
This is because we're going dark.
Oh, sorry.
Oh no, we're going dark. Where are you going to get all of your fantastic news from, everybody? I'm going to have to tell you the housing reports at Reports on Housing. So I would like to bring up some of my very helpful crew, starting with the beautiful, is that still recording? Just to make sure, because it sounded like it went off because she was touching it. This is the beautiful Athena Rose, right, Athena?
Yes.
So I would like to personally thank you for all of your wonderful help.
Hello.
And then we also have the magnificent Mason Thomas. Thank you, Mason, for all of your help as well.
You're welcome.
Somebody said they thought you had a fly on your head.
Somebody thought I had a fly on my head. Like a vice presidential debate, the infamous fly. No, it's actually a scab. Thank you. Well, I do want to bring up a special guest who hides behind the camera all of the time. She helps set up everything. She helps me with various ideas. She provides a lot of laughter, fun, and the beautiful brains behind the operation. Come on this side.
No, I'm just going to squeeze it.
That's my wife, TJ. That's it? That's all I get? Wow. Unbelievable. You might want to, I'll be recording this, you'll rewind it, you'll have to pause it to see her. But that's my beautiful, wonderful bride. She's amazing. Thank you for all that you've done. 51 episodes. Unbelievable. I was nervous the very first one that we were doing because I had not done Facebook Live. I've done some, but not to the extent that we've done over the course of the last, how many months? It has to be months for it to be 51 episodes. So, my background is I'm a quantitative economics and decision sciences major from UC San Diego in La Jolla, sister school of UCLA, just don't have football. 29 years in the business, Orange County native, Capitol Valley High School grad. I do have 9 kids. You've seen just 2 of them here. Then we have Zeke. Zeke's taking a nap. And we have others that are dotting all over the place. But yes, we have 9 kids. I'm an avid runner. And I brought 6, my wife brought 2. And I adopted her, she adopted mine, and we had Zeke. Yes. Well, he'll be 3 in February. Unbelievable. It's hard to believe. Anyways, time flies. My background is we've also been in the press. And our company is Reports on Housing. It's your local real estate snapshot. And really, you think you get a lot of content from these particular Facebook Lives, but let me tell you, I really drilled down the nitty-gritty of the counties. But it's not like some of these other, you can subscribe to like Altus Research or other chart-based websites and get a lot of information that's static. But what I want to bring is real expectations of the marketplace right now and where we are going in the future. So it's our company is Reports on Housing. We're not focusing on closed sales, although closed sales for the month of October looked absolutely fantastic. We went over that last week. We're dialing in the final numbers, and it will be part of the reports coming up this week for the along the coast. But our reports, we really don't want to focus on closed sales. what we want to focus on is the active listing inventory. What's going on right now? How many homes are available for buyers to purchase right now? Just a second, I have to do a parenting moment. Peanut gallery in the background. You guys can read that over there if you'd like, but I can hear you and it's very distracting. I love you. Those are my children in the background. Anyways, so back to the episode. So we're following the active listing inventory. That's the available homes to purchase, and then the last 30 days of new escrow activity. So based upon escrow activity and how many homes are in the market, we can give you what the speed of the market is. How fast are we moving? So, and right now we're of course moving really fast. But there are major changes going on in the marketplace right now, and we will talk about where we're at. Kind of talked about it a little bit. We were hinting at it last week, but this week we have the numbers that really help paint the picture of where we're at today. It's about setting expectations. We have reports that dot all over Southern California. So pick your county, and we have a report for it. And the most recent one that came out was Season's Greetings. Riverside and San Bernardino got this week. LA, San Diego, Orange County got theirs last week. There's another report that's coming out, and it's this coming up Monday that will be released. We just crunched the numbers last night. So that's when we do it. We do it on Thursdays. And reports on housing, that is our website. You can subscribe. Every 2 weeks this puppy comes out. We email you the most recent one, and then so if you signed up for OC San Diego LA, you get the one from a week ago on Monday, and then another one comes out this Monday. So we'll email you the last one. There's a bunch of links at the bottom so that you can utilize it in printing it out and then copy, cut, edit, paste, make it part of your logo with a Word document. Lots of charts. There's a lot of great information there. It's $15 per month or $150 per year. And you get a month free if you use the coupon code LastChance. Because like I said, this is my last episode for the year, and we'll see where we go from here. Our sponsor, let's talk about our incredible sponsor. Our sponsor, oops, I did this in the wrong order, so we'll go back. But first, I wanted to get into why you should be subscribing to the report. We're going to be highlighting the inventory changes because there's going to be major inventory changes probably for the next several months. We're going to see some definite shifts in the inventory. We're also going to see distress numbers change in 2021, and I will devote a special paragraph of the report to just talking about distressed foreclosures and short sales and be able to compare them to where we were in the past. Because that's where it's very, very helpful. Where have we been before and where are we at today? Because it's going to show a lot when we go from nothing to something, but that something is going to be very little compared to what we did during the Great Recession. And we've talked about that, we've exhausted it, but we will be bringing this in the form of the report in 2021. Interest rate changes. Now, I'm going to show you what happens with interest rate changes in today's broadcast, but you're going to see exactly why we need to be following interest rate changes and talk about what buyers should be doing, why they should be pulling the trigger before before we have changes in interest rates and what that does to the impact on affordability. Demand and escrow changes. So as that velocity changes, we need to follow it and see where we're at in comparison to history. And but now our sponsor, I want to really special thank you to Kevin Buddy, who's been there quite a bit. You've seen his face in my presentations a lot, and he's really stepped up and he's become a major sponsor of the Housing Debrief. So he's my buddy and your buddy, Kevin Buddy. That's a great way of remembering exactly who makes a difference in the financial arena, representing everybody that needs a loan. So he's with Monarch Coast Financial, and they, of course, deal with more than one kind of borrower, so they have more than one kind of loan. And they have many unique loan options out there, from full documentation loans to alternative documentation to investor financing and even to private money. So he's been around, knows a lot of people, very, very knowledgeable, so, and he's got the experience to back it all up. He's helped buyers for a very long time finance their dream home, and you know what? He's been doing this since 1976. Extremely reliable. So my friend and yours, Kevin Buddy. Contact Kevin Buddy and let him help you as well. 949-422-2075. That's 949-422-2075. Kevin Buddy at Monarch Coast Financial. And let's start with some, of course, some fall fun photos. These are some good ones. Oh, I should have put this at the end because this is the corny kind of stuff that I put a warning on. But I changed all my passwords to Kenny. Now I have all Kenny logins. I love that. How about the official Christmas wreath of 2020? That about sums it up. I think we should make this, make a little project. Coin shortage is from people wishing 2020 was over. Yeah, that's where the real coin shortage comes from. How about this one? English tutor. We had to block the phone number because, wow, that's the guy or gal I want tutoring me in English, because they're the English tutor. Bring them over and they might toot instead of help you out with your English. So another warning, this one should have been the other one also with Kenny Loggins, but this one's pretty good too. Attempting one of the most difficult plays in the game of baseball, stealing a base. My wife goes, why do you laugh at your own jokes? Because I find them funny. They're good stuff. That's how we rock and roll. So the Southern California market, yes, we are in the midst of a fall market, and it's very short-lived. We started it about, with this report, so it started about 4 weeks ago, so mid-October to mid-November, and now, boom, we're done. So what happens is we have a demand drops, and so does the supply. So we're having a drop in both supply and demand. Typically, this happens when the kids go back to school at the end of August, but we fast-forwarded it, or we actually kicked it down the road for a couple of months. And the reason for that is because of the fact that 2020 was discombobulated. We had a late spring market, then we had summer. It was shortened a little bit so we could go into our fall market, but yet everything was still elevated, and we'll get into that. The overall speed of the market has been extremely fast, and it remains fast even with the recent drops in both supply and demand. Because remember, if you have the supply, the number of homes on the market diminishes, and at the same time you have the number of buyers that are out there, or the number of new escrows diminishing, part of that is because there aren't as many homes coming on the market. Part of it is we're at the time of year where our attention starts to divert to other things. I just had holiday lights estimate about an hour ago at our house. So we're getting into the season, and people are ready for the season. I see people that are already dialing into 103.5 to listen to their holiday favorites already, because we are done with 2020. We want to go into 2021 and enjoy the holidays. So, but the overall speed, when you have demand dropping and supply almost at the same rate, you don't get a big significant shift in how it's slowing down. You would have to have the drop in demand and supply remain the same, but that's not what's happening. We're having the drop in demand and drop in supply. So let's talk about the supply and where we are. You can see this is over the course of the last 4 weeks. We've been going down, and it was yesterday was 24,993, so we went down. Last year we were 38,332, so that's the difference, 53%. You can see right here that if I draw a line across, we are still extremely low. As a matter of fact, this current level is 24,993, so we've been dropping down to low levels where we have never been here since March of 2013. There was actually, so I've only had 3 reports since 2012 where we had values in the 24s, so it was less than where we are today, but it wasn't all the way down to 23, so it was at 24,000 plus. And the lowest level ever was actually at 24,161, and that occurred in March. So there's only 3 reports where I did it. 2 were in March of 2013, and 1 was at the end of February, which is common. People don't think February is a busy month, but that's because there's buyers in the marketplace and there's not enough supply. So that is one of the busier months, is typically February, March, April is where we can bottom out in terms of the expected market time. And this is the active listing inventory where we're going to go for the rest of the year. So starting next week is the first week of of what I refer to as the holiday market. And that's where things start to downshift because we're getting ready for Thanksgiving, because the following week when I'll be doing the report 2 weeks from yesterday is Thanksgiving. So we actually won't be crunching the numbers on Thanksgiving Day. It will be a different date. I haven't decided if it was the day before or the day after. Doesn't really matter because they're very, very close, but this is where we will go down for the rest of the year. Inventory will drop at a more rapid pace. And people are going, how can the inventory drop from when it's already at a very, very low level? So we're going to drop to a level that will be lower than what we did back in 2013. And the reason for that is we have fewer homeowners coming on the market, and then we have a number of people that have been on the market for quite some time without success in every price range. And even the hot, like say for example, Orange County and San Diego County both have had, there's only 15% of the market between $500,000 and $750,000 that have been on the market for 60 days plus. But that's still 15%. There's over 100 homes in those two markets that have been on the market for 60 days plus. A number of those people will pull their homes off the market, and it'll happen in every price range. So with fewer homes coming on the market and people pulling their homes off the market, you're going to get this, the drop in supply. So there will be fewer opportunities for, as the supply drops, and so buyers that enter, they're actually going to be looking at fewer homes that are available. And as far as the number of for sale signs in October compared to 2019, I did this for all of Southern California. I want to bring it to you guys again, just so you see it. Los Angeles is up 19% year over year for the month of October. They placed 19% more homes in the market in 2020 versus 2019 in the month of October. That is actually, they've been increasing and they're continuing to go up. There's something going on in Los Angeles that's a bit different. Orange County was at 24%, but they've come down to 16%. So the year-over-year gains are beginning to diminish, as they are in the other counties, LA being the only exception. Something's going on in Los Angeles. Riverside's up 2%. Year over year for October. San Bernardino's up 5% and San Diego's up 2%. So not a big difference. This is not big enough for me. This is still big, but it's diminishing, and this is going the wrong direction, where there are a lot more homes coming on the market than last year, and it's showing in the overall market in Los Angeles. Los Angeles has probably slowed down the most out of all of the markets, and their inventory is doing something different. They will be the only county that will not achieve a record on January 1st of 2021. It's going to be Los Angeles. So they're actually muting all the numbers that we're seeing here, because all of these will hit an all-time low. And Orange County is going to go below 3,000 homes on the market. They were at a little over three, I think it was like 3,150 January 1st of 2013, and we're going to go below that in Orange County. So all the counties will, except for LA, will reach all-time lows. And some of them already have, AKA San Bernardino. That is ridiculous where they're at, like 2,600 homes on the market. So Southern California housing demand and its interest rates are ruling the day. But I will say, we've had a bit of a change, and that's because the 10-year Treasury is going up a little bit. We're starting to see a little bit of an increase in mortgage, in the weekly mortgage market survey. Easy for me to say. This was on Thursday, 2.84%. 2.84%. Last week was at 2.78. The week prior to that, it was at 2.81. So you can see this is why, well, it's not totally that off. We're still in the twos, everything looks fantastic, but I'll tell you, there's some pressure on the 10-year Treasury. It's going to start to increase as we get more good news. Pfizer's announcement of having the 90% success rate sent the 10-year Treasury up, where it's knocking on the door of 1. It's not quite there yet, but 1%. Remember, we've been below 1% since we've gone into this pandemic and did the lockdown in March. So now it's starting to knock on that door, and as we get more good news, when the FDA approval comes, when we get another relief bill, all these things will increase this interest rate, and I think there's a pressure on interest rates to rise from where they are today, 2.84%, to all the way up towards like 3.5% by year's end. And you're thinking, that's not that big of a deal, but I'll show you what that means. We've had 12 record lows so far this year, so just so you know, and 2.84% is still a phenomenal rate. And then let's talk about where demand is right now. This is the last 30 days worth of new escrows. So it kind of gives you how many buyers are actually transacting. And yesterday it was at 19,158. It was down 5% in 2 weeks. So down 5%, you could see it's starting to really come down. So it came down here and it's coming down at a greater clip. Yet we're still, even though it's coming down, you can see where we are this year compared to last year. Last year was 14,686 escrows. That's 23% less. And you can see it's 23% less pretty much all, and this was back when we had interest rates at 5%. So you can see we have considerable more demand even though it's dropping right now. And even when I look at the last 30 days worth of pending sales and I draw a line across, now we're getting to the point where we're hitting spring markets of each year. This is 2015, 16, 17. So, but it beats 2014 spring. It of course beats 2018 and 2019. And then it's 2013 spring. So that's where we're behaving right now as far as demand's concerned. And we're in November. And so you just need to know where we're at right now. It's the strongest November demand reading since I started tracking it, since 2012 actually. This was when we had a lot of short sales. So this actually is gonna equate to more closed sales than these extra pending sales, because these were a lot of short sales, and many short sales in 2012 that were placed into escrow never closed. They had files this thick because you had to get 1, 2, 3 lenders' approval, sometimes the federal government on IRS tax liens, things like that. Remember those days? So it's going to come back a little bit, not nearly like what you experienced before. We still do short sales out in the marketplace right now, and it's just going to be slightly bigger than what we're dealing with right now. That's a 2021 story that we've got into many times in other episodes. But demand, where are we going to go from here? It's going to fall. And partly, it's two-pronged. One is there are fewer opportunities, fewer homes, active homes that buyers can purchase today. So that as we go forward, as the inventory drops, they don't have as many choices. So there will not be as many escrows, A. B, many of these buyers will say, I've been doing this for quite some time. I need to take the rest of the year off and enjoy the holidays and all the holiday distractions, cuddle up next to the fire, drinking my spiked eggnog. How fun, right? So that's what people are going to be doing, and that's why we're going to see this drop in demand. And it happens every year. But I still want to point out this, that you see, even with this drop in demand, where we're at right now is still higher this year compared to all other years. So demand, while it's dropping from where we are today, will still be elevated compared to all other years, dating back probably to 2012 with short sales. And which bodes well for the number of closed sales that will happen actually in January and February that we're not accustomed to getting in residential resale. Those are typically the 2 months where you kind of take a nap. And then things get going as we place more into escrow at the end of January and into February that starts closing in March. So, but I want everybody to know the market is powerful. Demand is powerful. And as a result of that powerful demand, juiced by low interest rates, for many in the real estate industry, the holidays are canceled. You will be busier than you have in any other December that you can remember. So it's time to take advantage of the season. However, you're not going to be able to do as much of this like you normally did in the past. So, because the overall market is still going to feel really speedy. So those buyers that are going to go, I'm going to get in the middle of December. I'm telling you, as the inventory drops, so does demand. And you'll see that the speed of the market, the expected market time, where we are today, this is where we are. Yesterday we were at 39 days, up 1 day in the last 2 weeks. So it has actually risen a day, even though we've seen the drop in supply, but a bigger drop in demand. SoCal last year was at 78 days. So that's the difference between this year and last year. It's a much hotter market than it was last year. As a matter of fact, hot is below 60, and we're not used to seeing this hot of a market in the midst of October, November, December. It tends to go into what I refer to as the slight seller's market. So the expected market time and where the levels that we're at right now, you have to go all the way back here, and it's not quite even at 2013. It's still July through November is the lowest level since tracking. So we might increase a little bit from here, and the only time that beats it is the spring of 2013 as to the overall flow of the market. So buyers, be prepared. It's still going to feel really busy for the rest of the year and into 2021. And this is what we're comparing it to, 2013. So I'm putting all these lines up. I'm not going to get into what it means. These are the different ranges from deep buyers to slight buyers to balanced to slight sellers to hot sellers. Just know that from here to about here, here to here, actually, from here to here, there's not a lot of appreciation or depreciation. Even if you get into slight buyers, definitely not at balance, not at slight. It's just buyers get to call more of the shots, sellers get to call more of the shots here, and nobody gets to call the shots when it's balanced. However, when it's below the 60-day threshold, this is 60 to 90, that's slight, but below 60, it's a hot sellers. Remember I told you, 2017 and 2019 was slight sellers. And that is where sellers get to call more of the shots, but we're not getting that much appreciation. But when you're where we're at here, you're getting appreciation. You're getting appreciation because there's not that many homes on the market. And when one comes on the market that's priced really well according to its expected market time, lots of buyers will come in and a bidding war will ensue. And it continues to be that way as long as you price it as close as you can to the actual expected price. So you gotta price these properties very, very well. And when they're not, when you exceed where the market value really is for the house, then you sit on the market and you don't have a bidding war, and you actually have to reduce down the road and you throw away money. Where are we going to go from here? The holidays. Demand's actually going to drop a little bit faster than the inventory, so you're going to see this. You're going to see this slight rise in the expected market time. Remember, that's the speed. Expected market time is you place your home on the market, when are you going to open up escrow? Don't compare it to days on market. I don't like to compare it to days on market. I like to say it's way better than days on market because it's a true reflection of how much is on the market right now, the supply of available homes to purchase, and then I pit that with the amount of demand that we're experiencing, the number of new escrows. You put that together and that's where you get this expected market time, and it's a very good flavor of what the marketplace is like right now. So home values will be on the rise. We're below 60, but we're going to go into the holidays, but they will still be hot. However, what you're going to experience out there is demand drops faster and supply drops faster. I have already heard from some agents that have said the market is slowing a little bit right now. Yes, it is. We're at that time of the year where we actually are now into an autumn market, and then in about a week, next week, I'm going to start hearing it more, where people are going, wow, it's really slowing down a lot more, and activity is slowing down. And that's because this is where the sidelines of real estate occurs, where it's pretty much the holidays. So that's what will happen. So stay tuned for that. And then with values up, are payments too high? So I'm going to show you this. I'm going to go county by county really quick and just show you what's happening. In Los Angeles, this is the median sales price for a detached home, and this is as of September. They don't have October's numbers. I'm pulling these through CAR, and these are the dates going back in time. You can see how low we got, and you can see how high we were before. And in Los Angeles County, where this is right now, this is far exceeding where we were here. But look at the payments, monthly payment versus here. This is where we had a problem with payments and we had a problem with affordability. Median incomes have actually risen, so people can afford more, but we're still getting a little bit higher, but not much. $24.89 is pretty close to where it was last year, and 2018, $23.95. So you can see this is okay. It was a lot better 2017 earlier based upon the median sales price and the average interest rate. Yet these low interest rates, people want to take advantage of these low interest rates, and it's creating a lot of demand, and as a result we're getting a rise in prices. Now these are the median sales prices for the year. I'm just showing you this. It's actually going to be lower for the whole entire year, but this gives you, and it's a little bit more inflated because of luxury. But for this example, I still wanted to show you where we are today based upon most recent statistics and data. And if you see this, this is Los Angeles. Now, what would happen if we go up 5% in value and interest rates were to get up to 3.5%? Now, I think that this is real. By the time we get to the end of next year, we could realize 5% appreciation, as well as we could realize an interest rate at 3.5%. This is not bad. However, look what it does to payments. And if you go back one, you're getting up there. You're not quite all the way up to here, but it's actually getting up there, 3,355. So you can see that could dampen things a little bit as interest rates continue to rise. Before, when everything came off the rails, when we hit 5% 2 years ago, it's going to happen now when we get where things slow down a little bit when we get interest rates at around 4%. So just understand that. We'll still be lower, 3.5%. And this is Riverside County. Let's see, did I do this in the right number? I did that. This is Orange County. I guess I went too far, didn't I? I did go too far. I was comparing that to the wrong thing. So I apologize for that. So you can see 2819, I meant to go back to here. You can see how close it is in Los Angeles. So apologize for that. But you can see this is a rise in payments. For Orange County, you can see that the payment $2,960 is less than where we were last year, based upon where the median sales price was of of September, and at 2.9%. You can see that's still pretty darn good in relative to time, and you can see where we were prior to the Great Recession. Well, if we go up 5% in value and we have interest rates that go to 3.5%, look at what you're looking at as far as payment wise. You're looking at 3,355. So not quite 2006, 2007, but you can see the kind of pressure you have if we continue to have this march up in values as well as interest rates rising. And then this is Riverside, 1598. You can see it's actually just a little bit more than a year ago, but that's still really good. And you can see in time, yes, it was less, but here we were prior to the Great Recession, and we hit very high numbers, which is why everything imploded, because everything was too expensive and affordability was an issue. So if we go from 480 to 504, which is definitely doable, 2.9% to 3.5%, it should say 2021. I don't know why I put 2020. I was just putting this together beforehand, but 1598 to 1811, that would be up 13%. So you can see that's a little bit of a problem. 1811 isn't quite here yet, but it is starting to become unaffordable. And then we have San Bernardino, same thing. So not that much of a change right here from last year to this year because of interest rates. And you could compare it to here, 1,500 to 1,700. But we can get up towards $1,400 per month, increase in value by 0.5%, and mortgage rates go up. And then last but not least, San Diego County. You can see here, still it is actually just a little bit higher than a year ago in San Diego County at these lower, but it hasn't changed much, which is why there's so many people dialing in. And you compare it to back down here, $2,900 per month. Wow. So, but if we go up 5% in value and interest rates rise, you're looking at 2,772. So you can see how it starts to impact affordability if we continue to go at the velocity that we are and appreciating, as well as we get increase in payments or interest rates. So coronavirus, let's talk about this really quick. American public, I know we're fatigued. We're tired of talking about COVID-19 and politics, and yet, so I refer to it as the 1-2 punch. We need to be mindful of this COVID-19 second wave. And the reason we need to be mindful of it is, like the Federal Reserve said, the path of the economy will depend significantly on the course of the virus. There is good news though, but we're still in the midst of this second wave that everybody talked about. But the good news is Pfizer came out with, they have a 90% success rate with this COVID-19 vaccine, but they still need to go through the FDA approval. The refrigeration for this Pfizer one, there's going to be a second one, is ridiculously cold, and we don't have quite the manpower for it as far as getting it to rural areas and such, but they will be dealing with this. That's why they have the Army and everybody. There's some military leaders that are coming out with this rollout. From what I can tell, it looks like you and I, everybody out there, because there's only a certain number of doses that they'll have per month, and you have to have 2 doses of this. It looks like it's going to be, I'm going to guesstimate, it's going to be the latter of spring, maybe towards June, when we're all inoculated. And then we have, I wanted to go over, the European Union finally stopped skyrocketing and kind of hit a plateau. There are 8.8 million cases. And this has everything to do with them closing down their borders and then opening it up because they needed everybody to come for tourism and reinfecting themselves, and then they did this. And now they're averaging 199,000 per day for the last week. So still really high, but if you compare us to the EU, and this is normalized by population because they have a bigger population in Europe than we do, you could see we're headed right to where they were. So, and that's because our numbers, as you could see, there's about 4 weeks ago when I was doing this, and we were, or 3 weeks ago, we were just even with where this was during the summertime. And now look at where the United States is headed. 10.7 million cases. This is where we are at right now today. And last week we were at 65,000 on average per day for the last 7 days. A week later, 131,000 cases per day for the last 7 days. And I think yesterday was another record high. So, and just know where it's happening. You can see it's pretty much almost the entire United States that is having an issue. There's only one state that's going down, but pretty much all of it is going up at a rate of 10% or higher, and some of them, 18 states, at 50% or higher for the last week compared to the prior week. So California, 1 million cases. We just surpassed 1 million cases. Actually, everybody should know California is behind Texas. Texas has a smaller population, but they have more cases. They passed up California, and this is where we are as far as California is concerned. 4,700 cases for the last 7 days. That's the average. So it's starting to go the wrong direction, which we went from 6,400 actually last week to 6,800 on average per day this for the last 7 days. That's where we're at right now, because the numbers are starting to come in higher for California as well. So as far as unlocking or locking, it all has to do with this tier system throughout California, and it's based upon new cases per 100,000, and this is where the problem area is. Positive test rate, we've done really well right here, and health equity metric, only Riverside and San Bernardino is having a problem with it, and this is positivity rate of the 25% lowest income zip codes in a county. They look at the positivity rate there because that's where a lot of the problem areas have been coming from, is that population of the more dense population. So if you look at this though, I've got, it's not really going the right direction, because this is where we are right now. Only Orange County is in red, where you can go into a restaurant at 25% capacity. And LA was the same. They didn't really change much in a week. Actually, Orange County got better. I think that's about to change. We'll have to see. This comes out every Tuesday. Riverside got worse, San Bernardino got worse, and San Diego, they're the ones that went into the purple. So they had to close things back down. And I think that is happening right now in San Diego. So macroeconomic outlook, unemployment insurance, these are new claims. This is what it was. This is actually the lowest level since going into the pandemic, but it's still high compared to the highest level prior during the Great Recession at 665,000. The reason why this is so sticky high is because we shut down the economy. Everybody went unemployed. That was here. Then we opened things up, and then we'd have a surge in certain areas, and you'd have to shut down certain sectors of the economy. So we had people going in and out of unemployment, so this initial unemployment claim has been high, and it continues to be sticky high. And then forbearance dropped from 5.83% to 5.67%. There's now 2.8 million people that are in forbearance, and it was at 4.3 million. So all those people that thought this was going to get all the way up towards 10 million, look at where it's at right now. It's fallen. 1.5 million is what it has shed so far. So it continues to drop on a weekly basis. Purchase application index is up 16% year over year. We care about this because this foretells where demand's going for the rest of the year and into 2021. It's actually dropped. Last week was at 25%, the reading. This week is 16%. And that's because it's getting harder and harder to squeeze out positive gains over last year. And there's another, we were also busier in the month of November for many of the markets. So I have to take a look at all of the data. But so November started where it looked a little bit better as far as the season of November compared to other years last year. But we're still up 16% year over year, and it's 25 weeks straight of year over year gains. So this says a lot about how strong it is. Just don't expect this thing to be year over year positive forever, because we're going to get to a point where it won't be, and that's because we will be comparing it to the hot market of the prior year as soon as we get into 2021. So go to reportsonhousing.com, click on subscribe, and you get a month free if you sign up utilizing, it's $15 per month or $150 per year. You get a month free if you sign up using the coupon code LastChance, because this is my last episode. Like I said, we're gonna go dark. Monarch Coast Financial, Kevin Buddy, thank you so much for your loyalty and sponsorship. He deals with more than one kind of borrow and has more than one kind of loan. And Monarch Coast Financial, they have everything from full doc to private money and everything in between. Loads of experience, been doing this for a very, very long time. Great guy and very knowledgeable, been doing this since 1976. He's my buddy and yours, Kevin Buddy. And you can reach him at 949-422-2075. That's 949-422-2075. Kevin Buddy at Monarch Coast Financial. So, Housing Debrief, like I told you, we are going dark. And we're going dark so I can enjoy the holidays, and these Facebook Lives have been absolutely wonderful. But I also want everybody to tap into the housing report so that you see exactly where the market is heading from here to the end of the year. We will have we'll be doing our 2021 forecast in the month of December. So stay tuned for news about that. And we'll be doing little Facebook Lives here and there of about a couple minutes in duration, just to give you kind of like the main attraction of what's going on out there right now. So that's it, everybody. I appreciate it. I don't have any kids to show off right now because they are all, I believe they're across the street having fun. I don't even hear a peep. Don't even hear my dog. I hear nothing. So I'm going to be signing off and saying thank you for tuning in. Thank you so much for all of your support and subscribing to the Housing Report. This is all that I do. This is my only gig, and I had somebody tell me that they got so much from these housing debriefs that they felt obligated to sign up, and after signing up realized how incredible the reports were, leveraged it, and was able to get price reductions, was able to make a difference at their listing presentation, and they were able to encompass it and utilize it within their business. So I appreciated that feedback at a meeting I had last week. I appreciate everybody that has given me the opportunity to do something I absolutely love. That's bringing you the housing economics, and I just really appreciate all the people that have reached out and have given a lot of questions out there, and we've had the Q&As with cocktails and had a lot of fun in the process, and it was very serious, and we were wondering what was going to happen all the way back in March and April, but after we just stuck to the truth of data and the power of statistics, we saw through this and saw how powerful the market was going to be based upon an actual sound game plan of looking at real economic data. So thank you very much. I hope everybody has a wonderful Thanksgiving. I'm thankful for all of you, everybody that's been viewing, especially thankful for all my subscribers. I do have 9 kids, so it's definitely a help. So I appreciate all of you, and I'm thankful for this opportunity to do these Facebook Lives with you. So thank you, Facebook, for this opportunity and this vehicle to get the communication out there. So everybody have a wonderful weekend, and we'll see you another time. Stephen Thomas signing out, live from Ladera Ranch.